Good afternoon. Come on. Good afternoon. All right. Where's my mayor? Is he here? Ryan? Where are you at? Is Mayor Ryan here from Alsip? No? Okay. I was told he might be in attendance. Hopefully he'll sneak in later. Well, I understand my contributions last year changed the economic numbers for the bourbon industry. Did you see where they took over beer as the... Sorry. Okay. First off, we wish our scheduled speaker, Thomas Wallstrom, a speedy recovery. I'm not sure if anyone else here has had any staff illness issues, call-offs the last 3 weeks. It's been brutal at my shop, so anybody else have any issues with a lot of sick employees calling off? No? Just Michael? Okay. All right. Gives me great pleasure to announce in Thomas's place we have David Oppedahl, who is the policy advisor in the Economic Research Department at the Federal Reserve Bank of Chicago. David conducts research on agricultural sector and rural development, as well as analyzes business conditions and the regional economy. He directs the Federal Reserve Bank of Chicago's survey of agricultural banks on agricultural land values and credit conditions, and publishes the results in Ag Letter, the Chicago Fed's quarterly agricultural publication. In addition to his research, he monitors the regional economy through roundtables and other contacts, briefs senior staff on the agricultural economy, and organizes the annual agricultural conference. You're a busy guy. Before starting his career at the Chicago Fed as an associate economist in 1998, Oppedahl was a consultant in the Economic Research Department at the Federal Reserve Bank in Dallas. While at the Dallas Fed, he provided research support in the area of econometrics. He also received the BS in mathematics from Wheaton College, Wheaton, Illinois, and an MS in statistics from the University of Wisconsin-Madison. He also completed graduate-level coursework in economics while attending Southern Methodist University. Put your hands together. Join me in welcoming David. Thank you, sir.
Well, it's great to be down here in the Alsip area. I appreciate a great organization that you all are part of here. The CAIC is doing great work, and it's good to hear a lot of the stories that you're sharing, and it's my privilege to share a little bit about the economic outlook of the U.S. and the Midwest with you, as Tom was not able to be here, and he is doing all right, but he'll be back to work probably next week. So it's just one of the things you do, you help each other out, and so I'm here, and our boss is going to be up in Lake County, Illinois, and covering another one of his talks. So we're just having to kind of make do, and hopefully I will be able to cover the material in a manner that does him justice. So I added some of my own slides, but I'm also using some of his, and I just wanted to start out with, sorry some of you guys in the corners aren't maybe going to be able to see this, but this is the Chicago Fed National Activity Index, which tracks 85 monthly indicators and combines them into one number. And why do I like to focus on this? Well, because it's kind of like the pulse of the economy. You know, when you go to the doctor or you want to check how your heart's doing, you take your pulse. And this one number kind of gives you a feel for what the U.S. economy is doing on a monthly basis. It's taking those 85 indicators and kind of uses some fancy statistics to crunch them down. And if it's zero, that means it's around the trend growth rate of the economy, which is slightly under 2% in the long term. If it's above trend, then it's going to be positive, and if it's below trend, it's negative. And as you can see in the far left side of this chart, it was extremely negative in early 2020. And that was when we had, of course, our little COVID recession that was so traumatic for the United States. And so that short recession, the indicators showed, everything went down. But then what happened right after that? Everything went up, and we had a huge recovery as the economy started to reopen, And so it was just that 2-month window when we had a really tough time in terms of the overall economy. Obviously, there are many stories about continuing economic troubles in the recovery period, but really since then, we've been in a recovery. As you can see, there might be a month or two where we had a tougher time, but as long as it doesn't get down below -1, then it's not really as tough relatively. And if you go back further, in this data, it could go a lot further back and talk about the Great Recession in 2008 and 9, and that was another tough one, but not nearly as deep as the one in early 2020. But the recovery took a lot longer that time. And so when you look at that, last couple of years, it's hard to see in that first line there. So I wanted to kind of zoom in and look at the last year here, and we can kind of see that sometimes we've had, pretty decent growth, a little bit over 1/2 of the measure. So anything above 0, remember, is a growing economy, or above trend. At 0, then you're at trend growth. And so we had a few months where it's been a little negative, but at the same time, at the end of last year was when it kind of got a little more negative. And so we do see a slowdown in growth in this indicator at the end of the year. Almost all the subsectors, which you can see, the red one is production and income, then the kind of the tan beige is sales, orders, and inventories. The blue one is employment, unemployment, and hours, and then the kind of teal one is personal consumption and housing. So we have seen a slowdown in the last couple of months, and January we don't have a read on yet, but we'll see what happened there. Obviously, the income and employment was kind of positive in January when you look at the numbers from the Bureau of Labor Statistics, because we had over 500,000 jobs created by the economy. That was a surprise that it was that large. But you see a lot of the service sectors that have maybe struggled a lot over the last few years, they're starting to kind of return to more normal activity. People are starting to travel a little more. We were trying to book flights down to Scottsdale to see my brother in March, and it's getting a little pricey. So we'll see how, we do have our tickets, so I will be going down there. But certainly there's a lot happening in this economy right now. And one of the factors that's involved with the little bit of slowdown we've seen, of course, is what's the policy of the Federal Reserve on interest rates. So you think about how the economy was entering the COVID recession, and it was very tough times, and so interest rates were dropped again to about 0 in the Fed funds rate target, and it stayed that way until last year. And then when inflation started taking off, we had to start responding to that, and it kept taking off, so we've kept raising the interest rate target, and it's now a 4.5 to 4 3/4 range. So it's much higher than it had been, even compared to the earlier increase from about 2016 to 2020, and that was didn't cut nearly this large. But when you look at what's happening with the longer term picture, we still have relatively moderate interest rates. They're not up to the levels that we saw back in the 90s or earlier, as this chart shows, but certainly they're rising closer to some of those peaks we've seen since that time. And the continuation of those increases is something that I'm sure is on everyone's minds in the business community. So that's a key component of what's happening. But at the same time, there's a lot of support from other parts of the business community right now. If you look at manufacturing, the supply chains pressures have eased. You can see that in terms of delivery times, in terms of parts getting in on more of a regular basis, and maybe some companies are not over-ordering parts because now just-in-time is becoming more like just-in-time should be, instead of being just-in-case when you over-ordered things. So those are some of those kinds of pressures that maybe are helping to return profitability. And one of the ways to measure this, the New York Fed has come up with a global supply chain pressure index, and you can see that in 21, it really shot up, and then it has eased since that time. So we're starting to see some of those easing pressures helping manufacturing. When you think about the industrial production measure that adds all manufacturing together into one number, you can see that the dip down in 2020 and then a slow recovery since then until the end of last year, kind of a dip down in the manufacturing. That's the blue line here. And then when you think about motor vehicles, it's that's part of the manufacturing story, just that they couldn't produce enough motor vehicles during the pandemic. We had shortages of chips and other materials, and so there was the rapid decline and then a big pickup in motor vehicle industrial production, but then it had to tail off as the parts supplies and the supply chain story was restricting output. And then in last year, you started to see some recovery there until the end of the year as well. So there was a dip in manufacturing towards the end of 2022, and that does cause some concern. Obviously interest rate increases are affecting manufacturing as well. And one of the factors that you have to keep in mind is that fiscal stimulus is continuing to kind of give the economy some support. And it's been a very unusual period where we had very large stimulus payments from the federal government to states, from the federal government to individuals, and that boosted personal savings rates dramatically during the the early part of the recession, and you didn't have any place to spend the money, so you saved it. And then as the economy started to open up, you could start spending more, and of course a lot of that was on goods. People, were able to stock up, remodel their homes. You had lots of people wanting a bigger TV because they're stuck at home so long. And so there are lots of different stories about goods activity picking up dramatically. But still the fiscal stimulus was pretty strong. And now the personal savings rate, you can see tailing off in 2022, and it got a lot lower because people had been spending what they had saved up, and so they weren't able to save as much. But now they're getting to the point where they're starting to think about saving more, and according to the S&P Global forecast, the savings rate should be rising over the next couple years. So that's kind of one of the stories, I think, that's helped to keep consumption quite strong during the recovery period. And the last couple of years now, maybe it's starting to be a little softer, especially the goods side of consumption has been falling. Services still seems to be recovering and growing up a little bit. So it's a challenging time to kind of know exactly what's going to be happening, but certainly that stimulus has helped to get us through the worst of COVID effect on the economy, but at the same time, now the stimulus is waning as the government money is being used up, and then the Federal Reserve has started to raise interest rates. And when you think about the growth, it's slowed, but certainly it's still positive. At this point, hopefully we won't have a recession, but that is a possibility, and a lot of economists are expecting that this year. And this forecast from S&P Global shows a little bit of a downturn in the first quarter of this year. At the same time, there's still some positive, aspects. I mentioned employment still quite strong, so that's something we'll talk about a bit more in a minute, but there are a lot of risks to the downside in terms of inflation remaining high. It does seem like it's easing, but how quickly that will happen is a question mark. And then, of course, we've had some war in Europe with Russia attacking Ukraine, and that's certainly a tough thing for the world economy, and we'll have to monitor that, although markets have kind of settled down after the initial year of has gone through, and we'll see if that maintains. And of course, the other risk to that downside would be another large COVID wave, which certainly seems like it won't impact us the same way the initial one did, just because the virulence of the disease is not as nasty, even though it can be still very debilitating. So there are some positives, but there are also some risks that we have to be thinking about. And so the chance of a recession is there. Longer run increase in the economy should be about 1.8%. And so we'll be under that this year, according to the S&P Global forecast, 1.1%. So slow growth, so that's, that initial Chicago Fed National Activity Index will probably be a little negative over this year just because it's going to be slow growth and it wouldn't be above trend growth like we've seen much of during the recovery. So what's leading to that specifically is a lot of it is driven by investment falling. If you look here at the chart, you can see the different aspects of the economic growth. The investment is the reddish line. Consumption is blue, which is looking to stay mostly positive over the next couple of years, according to the S&P Global forecast. But then the investment is kind of strongly negative for a few quarters here before it starts to be positive again later in this year. One of the other aspects that's been pretty positive lately has been government spending. Governments, especially state and local governments, have a lot of funds that came through the stimulus that haven't, it takes time to work things through. We have an infrastructure bill that was passed, so there's going to be some additional stimulus coming through from that. And so that's still a positive in many quarters, but not obviously all of them, as you can see back in 2022. And then net exports have actually been a positive for the U.S. economy in most of the quarters recently. So it's so those positive contributions are continuing. But when you look at the investment side, one of the key components of the investment is the housing. And housing markets have been under a lot of challenge in 2022 as interest rates rose. In this chart, you can see they rose up to levels they hadn't been at since 2000. And so there was a very rapid increase there, along with the increase that occurred in the Fed funds rate and a lot of other interest rates. And so then naturally, when people are looking to buy a home and the price goes up pretty dramatically because the mortgage is much higher and more costly, that's going to slow down the housing sector, and probably you can make a good argument that they have been in a recessionary period in terms of the housing side, even though most of the rest of the economy has kept moving forward. And as you can see here a little bit at the very end, we did have some relief in terms of mortgage rates towards the end of 2022 and into early 2023. So interest rates, though still higher, are not super high. They haven't risen to levels that were back in the 90s or earlier. So we still have a situation that as people get readjusted to their thinking, if you're thinking about getting a 3% interest rate on a mortgage, now when you're facing a 7% rate, that's a huge, it's massive increase. And so, but now maybe people can start thinking about that we're probably going to have interest rates in the 6 to 7% range, and so it's not as damaging maybe for the housing markets going into this year, just because people can reassess, and maybe there has been some decrease in home prices in certain parts of the country particularly, and so that can kind of help reset that market. But we still need more housing in many areas of the country, and it's just not being built as rapidly as it was in the early part of the recovery when it was a boom again. So housing, residential investment is a big part of what's happened with the investment components. You can see that red part there, and then business fixed investment is the blue in this chart, and that's been a little positive in 2022, but at the same time a little more negative right now is the expectation before it moves positive again and into 2024. And so interest rates being down a little bit has helped there, but at the same time, the Fed funds rate target is still continuing to move up, and so that we'll see how that works out going forward. So one of the other sectors I mentioned that's so important is consumption. Almost 3/4 of the U.S. economy is based on consumption, and so that's a huge part of what boost economic activity. And there you have a lot of sensitivity to interest rates with durable goods, particularly cars, with auto loans having to be more expensive. And so there's some pullback there, even though there was a lot of buildup of people that couldn't get a car during COVID, and then they now are being able to deliver those more regularly. And so there is some challenge there for that sector, as I had already showed. But at the same time, the service industries in particular are the ones that are continuing to move things forward in consumption. And so services is the blue part of this chart, and it shows pretty positive numbers for this year and next year. And so it's the anticipation would be that services continues to be a driver as our economy really shifted from being a goods-based economy over the long term to a service-based economy, with a little blip there during COVID when goods became the bigger part of, there was such a big increase there, but services were constrained much more so by closures and restaurants and hotels and things like that not being used as much in their capacity. So now there's been improvement there, so that continues to be a positive thing. And so we'll see moving forward how it all works out. But after some slowdown now, hopefully consumption will pick up again later this year. Now on imports, we see a huge increase after COVID decline there in 2020. There was a sharp drop off, but then they came back quite strongly, and the U.S. economy was buying more, and we were starting to get more shipped. Things were flowing into the U.S., and then there started to be a slowdown there in late 21, it looks like, and so we've seen a slowdown in imports. Exports have been slowing too, but not nearly as much, so that makes it so that there's a relative improvement in our economic growth from having slower imports and exports kind of not slowing as much, so then the relative change is a positive for the U.S. economy. So we can see that in the earlier chart that there was still some positive net export contribution to growth for the whole U.S. So at the same time that we've seen some slowdown, we don't really see that in terms of the labor markets. They're still quite tight, and you can see that partly because there's been a return of people to the labor market after the COVID drop. This is the labor force participation rate, which had been on a long-term decline, and then a spike, then the plunge for COVID, and then some modest recovery until 2022 kind of flattened off. And so the anticipation would be that the participation rate will continue to follow kind of the long-term trend of a downward trajectory, but at the same time, it moves around a lot, and you do have people that are returning from being on the sidelines to being willing to work in the, you had a lot of early retirements during COVID. You had people that were having to have child care issues, elder care. And so there were a lot of needs that people had that they couldn't go to work always. And at the same time, you could maybe work at home some, but not in every case was that possible to be able to work at home. A lot of jobs didn't, require you to be in a facility, in a manufacturing plant, and things like that. So we have seen a return in the labor force participation, but at the same time, in the long run, at least, the anticipation is people like I'm a late baby boomer, so those of us will start retiring before too long, and the other baby boomers are already, a lot of them on the sidelines. So it's a period that the U.S. economy is going to have to face this continuing long-term trend. But for right now, unemployment is as low as it's been in 50 years, 3.4% last month. So that's just amazing given the slowdowns we've had, the slower growth, and the concern last year about already being in a recession, but the labor markets were not acting like it. And so we have had a lot of layoffs, at various kinds of companies, especially high-tech companies. But they hired so much during the recession and the COVID period that they, even though they laying off some employees, they're still positive relative to where they were prior to that in terms of their employment. So employment rates are just extremely low, and you can see that the anticipation would be that with some slowdown, they might rise up towards the long-run unemployment rate of 4% that's anticipated for the economy overall. But still, still quite low after the huge spike during COVID and then the gradual declines we've had. So now, not all educational levels are seeing the same benefits from that low unemployment rate. If you break it out by the amount of education employees have, you can see that if you have a bachelor degree or higher, your rate of unemployment is well below that of the others. And some college is maybe a little bit above that, near where high school graduates are, the red line. But then if you have less than a high school degree, which is about 7% of the U.S. workforce, then you're closer up to about 5%. But all those levels of education are declining. It's just that the ones as you have more education, the chances are that your unemployment rate is going to be much lower. So I think that shows the benefits of education, but at the same time that the recovery is not equal across all different kinds of workers. So that's a challenge that needs to be looked at somewhat more in depth, and not necessarily just by the Fed. Since our tools are kind of more broad, we just have the Fed funds rate and other large aggregate kinds of approaches, not micro approaches to deal with those issues. But when you look at it overall, the number of unemployed workers is fewer than the number of job openings. So in this chart, you can see how the demand for workers has outstripped the supply of labor because there are more jobs available than there are unemployed workers. So then, you start looking at, the long run, since the middle of 21, we've had this situation where there's, high demand for workers because there's jobs available, but there just aren't that many unemployed people that are able to work. So labor markets continue to be very tight, and it's led to a lot of increases in employment costs. If you look at wages and salaries, which is the green line in this chart, and the benefits, which is the red line, they've risen quite strongly in the last couple years. You can see they've been up over 5% last year at one point, even though they tailed off a little bit towards the end in benefits, and wages were just slightly above 5% at the end of last year in terms of a change from a year ago. So those aren't all-time highs, but still, they look pretty strong. But there's a big caveat, and that is that when you adjust for inflation in real terms, people weren't gaining anything last couple years. Inflation took off, and that took away the buying power of the American people as they were not able to, the increases in wages and benefits didn't keep up with those increases in inflation and in prices. So that's a big challenge right now, and you can see that in this chart. We have inflation that's been the highest since the 1980s, and it has started coming down. This is the Consumer Price Index, which was released yesterday again and showed a small decrease, but still a little over 6% for the overall increase from a year ago. And then when you take away food and energy, which is the blue line, that's little under 6%. And so that's kind of what we think of as called core inflation. When you strip out some of those more volatile elements, that gives you kind of a feel for where things might be headed a little more. And there's even been now a super core discussed as in terms of if you take out some of the rental and look at more the service side of things in terms of the consumer price index. And so there's still some concern that the service side is seeing stronger growth in jobs, and that's leading to higher wages there that might continue to keep our prices at a higher level over a longer period. So there's certainly some concern about how quickly the consumer price index might come down. And of course, some of the things that have contributed to lower prices recently have been that oil prices have been dropping in real terms. Since the middle of 2022, there was a spike in energy costs as Ukraine was struggling to fend off Russia, and then that led, to lots of issues with the sanctions, and the energy scenarios in Europe being very extreme, particularly for natural gas. You can see there was a dramatic increase last year in natural gas prices, but they've come down as well. So even though we might see some current increase in gas prices at the pump, heating homes, and and then energy costs for industry have come down quite a bit in the recent half year or so. So it didn't end up being as nearly a nasty scenario as many expected, and partly that was a less cold winter in Europe in particular, and so there wasn't as big a need there. But you can see kind of how the U.S. is now much more intertwined with what's happening in other parts of the world. Something like natural gas. We used to be, for over a decade, as we had fracking come into play and our own production of natural gas grew dramatically. Then we had a period where natural gas prices didn't spike up all that much, as they had prior. If you look back to 2008 and earlier, some of those big spikes there. And then last year it surprised people somewhat because not only were we producing less natural gas after COVID had slowed down some of the exploration, but then we also started exporting more of it to Europe because Europe really was in need of natural gas supplies. They were trying to replace those that they'd lost with Russia, and so there was a big spike there, and so now we're able to export more liquefied natural gas, and so that's a boom for our exports, but at the same time it's led to slightly higher and maybe even more than that increases in prices for domestic natural gas. So now energy costs have come down, so that's helping to slow inflation, and it's and inflation's coming down. Here you can see the personal consumption expenditure index, which is this is the core version, so it takes out food and energy, but that one is anticipated to be moving down towards the longer-term trend, of around 2% in the next few years, according to S&P Global. The blue chip forecast, another group of economists that make forecasts and they combine them together. They have a forecast of 2.4% inflation from a year ago for Q4 of 2023. And then, that's getting reasonably close to the Fed's target of 2% for the overall personal consumption expenditure index. So it seems like we're making progress, but it's too soon to call the end of rate hikes, as I'll mention a little later too. Now, shifting a little bit to thinking about more local outlook, here you can see the United States change in payroll employment index. So in 2020 it was 100. So this is not the total number of jobs, but it's the change based on the changes in jobs. And you can see how in February, March, and April there was such a decline in the jobs for the nation, the dark black line, and then Illinois, it was the blue line, and all the other states are the many other lines there. So this is some work that Tom has done. And you can see the recovery. Illinois was slightly behind the United States in recovering, partly because I guess you would anticipate that given that some of the closures lasted a little bit longer in Illinois. And then there's been generally good progress for the U.S. overall, slightly above where we were prior to the pandemic in terms of employment. Illinois is still below its pre-pandemic level of employment. So the local outlook is being driven by longer run fundamentals as well. The initial shock, has pretty much passed, but at the same time, the states that had the worst of the recovery in terms of the levels are ones that maybe had higher shares of leisure and hospitality employment, and so there are some things holding back Illinois' employment levels, and that's something that if you look at this next chart, you'll see that we're really in kind of the longer term, barely into the third quartile. So you break the U.S. employment in terms of pre-pandemic growth, and the blue is the first quartile, the states that were growing the fastest, and then the second and third are the middle 50%, and the fourth are the lowest. So Illinois was just above those lowest, and so it's really kind of been slow growth for Illinois for a longer time, and they're still in that kind of a position coming out of the COVID time period. And so it's a challenging time. The growth may not be as strong. It may take longer to get to the level of jobs that we had prior to the pandemic, and at the same time that fits in with the longer pattern. So that's some challenging issues for the states in the Midwest. It's not just Illinois, but others as well have faced some of those kinds of patterns that need to be dealt with longer term. So now let's transition to a little bit about what the Federal Open Market Committee sees happening in the economy. This is the organization in the Federal Reserve that makes the decisions on when and how much to increase interest rates or to decrease them. And the Federal Open Market Committee has every other cycle, they meet 8 times a year, so every other meeting, so 4 times a year they come up with a forecast of what they anticipate is happening with the U.S. economy. And here you can see that this is actually from December still, and there'll be a new release in March with the next meeting of the FOMC. The expectation at the end of 2022 was that we were going to have the personal consumption expenditure index inflation rate be about 5.5%, and that's pretty much where it ended up. And then the anticipation would be it'd be falling down towards around 3% this year and 2% in the longer run. Now, the way to read this in terms of these little charts is they have little stems on them to show, based on the reddish line, which is the median, the middle voter on the FOMC, and then the little lines show how the range was. And so the range is coming down for expectations of inflation, but some think a little faster than others. And so the voters include my new boss, President Goolsbee. He took over last year from Charles Evans, or last month, excuse me. And so he now is a voting member, as well as the Board of Governors and the other 12 Federal Reserve Bank presidents are all the members that are pegging these values here. So inflation is headed down in terms of the expectations, hopefully faster than maybe some are thinking, but at the same time still headed towards that 2% target over time. And in order to have a scenario where that's possible to have that kind of decline, we need to have some lower demand in the economy. The economy has been so strong that it was growing gangbusters, and so when that happens, inflation can pick up. We had kind of some supply issues with COVID, and so that was a real challenge. So 2021 we had a huge spurt of growth for the economy, increasing over 5%, and then 2022 it fell back, and we don't have the final number yet, but still quite a bit lower for and more little between under 1% probably is the expectation here, based on we had 3/4 of the data at that time, and then rising up towards its longer run increase, which is about 1.8% in the long run. So that's the anticipation, not a recession, but at the same time there is a possibility of some downward quarters here, as we've seen in the last few years too sometimes. But at the same time that we have such a slower growth period, we also would anticipate unemployment rising some, not getting up to the peaks we saw during the COVID times, but certainly moving up from the very, very low rates at it, what it is right now. Finally, when you think about how we're going to achieve something like this, which often is called the soft landing, it's what the Federal Reserve is hoping for, but at the same time, it's hard to achieve. So we'll see what happens there. The Federal Open Market Committee in December of 2021 anticipated this sort of increase in the Fed funds rate. So this is when there was starting to be some pretty, big concerns about inflation. So the Fed was starting to look at increasing interest rates, and this is typically called the dot plot because each dot represents one voting member or one member of the Federal Open Market Committee's views. And so at the end of 2021, expectation, interest rates would stay low then, and then in and then over time they'd start rising up towards the longer run, which is around 2.5% there. So we were anticipating that they'd be moving up from 0 to 2.5%, and then we'd see that everything was working well, in terms of having a increase in economic activity, but at the same time not having huge inflationary pressures. Now, when you look at what happened in 2022 at the end of the year, not only had we already moved above that 2.5% longer run level, we were up close to 4.5% in terms of the Fed funds rate target. So in that 1 year period, inflation reared its ugly head and had to be attacked in terms of the main tool that the Fed had for monetary policy, which is the increasing the Fed funds rate target. So, a huge shift in perspective, and now the anticipation would be that there needs to be somewhat more of an increase. We've already had one increase this year, but it was a smaller one of 25 basis points, and so that's moved us up closer to 5% on interest rates, and we'll probably get there at the next meeting, although we don't know exactly the timing on increases this year. The Fed Open Market Committee is data dependent, and so depending on what's happening, they could increase a little faster again, or they could just maintain the slower pace of increases after last year's very rapid increases. But the Fed Open Market Committee anticipates to keep raising rates up towards 5.25%, 5.5%, somewhere in there, before then starting to lower them next year and the year after. So moving down towards the long run as inflation starts to ease more and we start having inflation down towards the 2% target, which, we had inflation very low for a long time, so now having inflation high for a little while is not, something that was unanticipated, but at the same time, it was, unexpected in how quickly it did come. So that's giving you kind of the perspective of the Fed, and at the same time, we'd be very happy for you to share your knowledge with us. This little, dinosaur logo there is something that leads you to our Chicago Fed survey of business conditions. And probably some of you have already been filling that out, but if you haven't and are interested in doing so, please get in touch. You can come up and talk to me, or you can find us on our website. So that gives us a lot of helpful information and brings us more knowledge on what's happening locally, which is of big value to us. And that's my remarks. I'd be very happy to take some questions.
Questions, anyone? Here we go. We'll start out with Jim.
Can you give a short synopsis? What happened to the Phillips curve that we all learned back in Econ 101?
Well, the Phillips curve still exists, but it's a theoretical construct that has not been so helpful lately. And so the Phillips curve, in the 1970s, when it was developed, was very helpful in thinking about these trade-offs of inflation and unemployment. But the economy's changed in the last 50 years, and so there have been a lot of things with the knowledge economy and information technology that's really changed, I think, a lot of the effectiveness of viewing that as a tool. And so there's still a lot of research on that. I'm not an expert on macroeconomics, but in a nutshell, it's just not as useful for thinking about the economy.
I'm going to cheat because I have one question, but this question made me think of a second one.
Okay.
The first I have is, if 2/3 of the economy is based on service, why is so much of our tax policy focused on investment, particularly around real estate? I don't understand those things don't seem to be real estate. The second is, with all of your projections going forward, how have you guys accounted for artificial intelligence and automation as a driver in changes of any of the economic indicators?
Well, you wanted to give me all the easy questions, right? AI and technology, of course, are going to explode. We can see a little bit of the beginnings of how that's affecting things, and in terms of search engines, and obviously businesses are using it in new and there's going to be lots of innovations. So I think it doesn't necessarily come into play in our forecast directly, but you have to be thinking in the long run that there's a lot of challenges in implementing that, but at the same time a lot of opportunities. So that's going to be interesting to see how those dynamics play out. With robotics and things like that starting to have a bigger role, and a lot of companies seeing the shortage of labor that we have, and we're anticipating having even the next after the baby boomers, the next generation is smaller. So there's going to be fewer workers, and we need to come up with new technologies and be smart in how we use those workers. So hopefully everybody gets a good education, and not necessarily college, because technical community colleges can give you all the education you need to be part of the economy, but you just can't stand still. You have to be learning, and those kind of things will come to play. In terms of tax policies, there's a lot of things that happen at the state and local levels that aren't necessarily based on the mix of what's happening. It might be from 50 years ago thinking, and so we maybe need to update our tax policies, but that's not something that I'm going to be able to really get into today.
Where does the Fed feel about the U.S. dollar value going forward?
We think it's a strong value. We take dollars from the federal government and we put them into circulation, and they have a they're still the world standard, and so the value of the dollar itself in terms of other currencies is something the U.S. Treasury Department is part of their portfolio. So the Secretary of Treasury handles that, and so the Fed does not have a specific position on the value of the dollar relative to other currencies, but the U.S. dollar has been strong, so that's been a little bit of a headwind on our exports, but we've still maintained our exports pretty well in the last year relative to our imports. So you would think given where the dollar's been, maybe it would have been the reverse. So that's a little bit surprising.
Another question? Here we go. Over there.
Based on yesterday's CPI data and the most recent jobs report, in your opinion, is a half-point raise on the table more than it was a couple weeks ago?
Well, that's not something I can really comment on. As my president is the one that it's his responsibility to talk about that kind of issue. But what I will say is that many of the other leaders, I think, have been talking. The Fed presidents, have been speaking to the press, and it seems like there's still, plenty of support for, an additional quarter-point increase. Probably not so much for a half, because the data maybe wasn't as much of a slowdown in inflation as people would have liked to see, but still, it's headed in the right direction. So if we're going to have, as the Federal Open Market Committee has shown in their projections, that maybe 5.5% is where we top out, if that's where we top out, we're getting close. So a couple more 0.25% increases would get us there. We don't need to rush it with a 50 probably.
I think we got time for one more, and one more question. Anyone? Wow, that's pretty good. That means your messaging was very good. Ladies and gentlemen, thank you very much.
Thank you.
All right. So I would first of all like to thank the Doubletree for the great job they did and the staff for a wonderful meal. And I've just got a couple of brief announcements. First of all, I'd like to acknowledge some elected officials in the room. Mayor John Ryan of Alsip, who's you can't have a better friend of manufacturing in Alsip. I know Mayor Ryan and what he does in this town, and there is no better host for manufacturers that welcomes industry in. I think his middle name is give him the 6B and get him in here. Thank you, Mayor Ryan. And also is Denise here from the Alsip Industrial Association? No. But Alsip Industrial Association, by the way, a good organization that we partner with. Would like, just acknowledge them. And then my alderman from the 9th Ward, Alderman Tony Beal. And now that have to prove that we're nonpartisan, we have Tony Ferraro from U.S. Senator Mike Braun's office from the state of Indiana. I've done this before at a luncheon to prove that, we're nonpartisan. I'm a trade union Democrat hired by a bunch of Republicans, so, in this job about 15 years ago. So, and that's the truth, so I'm very grateful for that. But upcoming events, we're going to be back here in Alsip as a guest of the Alsip Industrial Association on the 12th, and I guess we are going to be doing a thing on workforce development resources for manufacturing, so it'll be a joint effort with the Calumet Area Industrial Commission and the Alsip Industrial Association. If you are located in Alsip, I would suggest you join the Alsip Industrial Association. They have a lot of good information and they can help you out. We're not competitors of theirs. We work jointly together like we do with the Bedford Park Clearing Industrial Association. I don't know what is going on 127th and Cicero, but they sure do know what's going on here, like the Bedford Park Industrial Association will telling me what's going on 79th and Oquito, and I rely on them to keep me informed. So these other industrial associations are good to be members of. So that's coming up on the 12th. The other thing that we have coming up with the Calumet Area Industrial Commission, we are going to have BP, which is a member. I don't think they're here today. Are they? No. They will be doing a presentation sometime in either March or April. We're trying to get a date. Their economists will be coming out from D.C. to give us an idea of where oil prices are going. And I think most everyone realizes it's not only the price of gasoline that's affected, but whether plastics and everything else that from fossil fuels are affected by what happens with the price of oil. So in manufacturing, that affects everything that we use daily. So we're going to get their economist out, and I've heard him speak before, and he's very knowledgeable on what we're facing in oil prices. Also, I've heard the Illinois Environmental Protection Agency director speak at the Illinois Manufacturers Association. He's agreed to come out and speak. We may end up with both of them coming out separately, of course, doing in April, or if we can, we're going to split them up between March and April, and depending on how their schedules work. But that will be upcoming, and we'll let you know on the dates as that comes out. I'd like to thank everyone for coming out tonight, a nice crowd, and I'd like to thank my wonderful staff for always making me look good in spite of myself, and have a wonderful week. Thank you.